Okay, so in this video you're going to be talking about market structure. I want to simplify market structure for you so that you can, even though you're a beginner, a complete beginner, you can understand what's actually market structure. So if you're always interested in this type of videos, you can consider subscribing, liking, and either commenting down in the comment section. If you have any question, I'll answer it. And if you need more guidance, I'm there to guide you. So what market structure is so complex. So let's say market structure, let's turn it on how price moves. Okay, so market structure is just simply on how price moves. So generally in this video you're going to understand what's market structure, the types of market structure, the basic words to understand market structure, and by the time I finish the basic words to understand market structure, you would have already understood what's market structure. Okay, so the first thing is what's actual market structure. So market structure is just general on the way price moves. So if you can see here on the charts, just on the way, just on looking on how these charts are moving, that's generally what's market structure. Is the market going up or is the market going down? So that's what market structure is. So we have types of market structures. Okay, so we have the bullish market structure, which looks like this. As long as you're seeing a market that's going up, which is actually here, which you're seeing here. Okay, as long as you see a market going up just like that. Okay, if you see a market that's going up just like that, that's a bullish market structure. So we have a ranging market structure when the market is not breaking either up or down. So we call that a ranging market structure. So the next market structure is a bearish market structure when the market is actually just going down. And the example may be this. Okay, so as long as you see the market that's just sloping down, meaning that's a bearish market structure. Okay, so now what are the basic words to understand market structure? So this is where by the time I finish to explain to you the basic words to understand market structure, you would have already understood what's actually market structure. Okay, so let's begin with the bullish market structure. Okay, so I'll be using these, let me call them, are they arrows, are they sticks, whatever. I'll be using these arrows to explain to you very well what is a bullish market structure. Okay, so a bullish market structure is that structure that the market is going up. Let me say, for example, if it's a ladder, okay, in form of a ladder, if the ladders are going up, okay, or the steps, let me call them steps, if the steps are going up, meaning those steps are bullish. Okay, so let me say you're going on the up floor, okay, and you're taking steps, so meaning you're taking steps in a bullish way. Okay, so you're going up. Okay, right? So that's the same as market structure, and that's the same as the market. So if the market is just going up, as you can see here, okay, it's just going up. Okay, meaning the market is bullish, and meaning the market is in an uptrend. I can call it an uptrend, I can call it bullish. They are the same thing. Okay, what makes a bullish market structure bullish? I can show you this and it looks like a bullish market, but if I'm to zoom in, okay, if I'm to zoom in this market structure, you actually see, you just actually see, if I'm to zoom in here, you'll see it being bearish. So I haven't done okay, we'll just see it going down, okay? Meaning, what actually makes it being a bullish market structure? So we have what we call higher highs and higher lows, okay? What do we call higher? What are the higher highs and higher lows? So the higher highs are, using this example, these are the steps that the market takes either before going up or before retracing. So I have introduced another word, which is retracing. What's retracing? Before I explain what makes it become a bullish market, okay? So if you're to see, we have this where the market goes up, then we have this when it actually comes down a little bit, okay? Then we have this, okay, where it goes up again, and then we have the other way where it comes down a little bit before going up, okay? So these are two steps, okay? The one step is called impulsive and the other step is called retracing, okay? So we have the impulsive move and we have a retractive move, okay? So when the market goes up first, before it continues, the market won't just go up and keeps going, and it keeps going and going and going, as you can see here, okay? As you can see here, the market won't just be going up and it keeps going and going and going, okay? It will actually be retracing at some point. So if it goes up a little bit, it retraces before it goes down, before it goes up, okay? Before it continues, then after it retraces a bit, before it goes up, okay? Then that makes it a bullish market structure as long as it has not broken the last low, okay? So we have the higher high and the higher low. So this tip where the tip that the market makes before retracing is called a higher high, and the last tip that the market makes before breaking the last tip it made before retracing. I don't know if you have understood that. Okay, let me repeat. The last tip the market makes before retracing is called a higher high. Before making this down move, okay, is called a higher high. And the last tip the market makes before breaking this tip is called a higher low, okay? So, okay, this is a higher high. This is the tip the market made before retracing. And we can see we have this tip. The market made it came a little bit up, but it never broke this tip. So that does not qualify to be our higher low. And we have this tip also. The market made it, yes, but it never broke this. It never broke this higher high. So meaning it also does not qualify to be our higher low. Okay, so we also have this. So this is the last tip the market made, and it came straight away and it broke this higher low, meaning this will qualify to be our higher low, okay? So then we have this tip, the market made it, and then after it retraced. I have already explained what retracing is. So after retracing, after making this tip, the market retraced, meaning this will make it our higher low, our higher high. Okay, then we have the steep. Then we have the steep. Okay, so before the market breaking, before the market breaking this higher high, this was the last tip, so making it our higher low. Okay, yeah, let's go on. So the market kept going. Okay, so the market kept going. I don't know if now you can understand what a higher low is and what's higher high. So now we have this tip. Can we call this our higher low? Like, can we call this our higher high and this our higher? Like, can we do this? No, it will be wrong. Why? If we are to zoom in very well, okay, all this movement just happened between this candle. So at least if this candle, okay, this candle broke below here, okay, but at least if there was a series of two candles going below each other, that's when we would call this a higher low. But here the market never retraced. All the movement was in between this candle. I'm talking about this candle. Okay, all the movement was in between this candle, so the market was just in between there. So that's what we call a higher low. Let me just give you another example. Higher low, I've explained a higher low, a higher high, a retracement, and an impulsive move. Okay, so let me show you another example. Let's just continue with this. So we call this our higher high. Okay, this is our higher high here. This is our higher high. So the market went up. It went up from here, from actually here down. It went up direct. Let me first remove this. So the market went up from here direct, then it came here. Okay, then it made our higher high. Why do we call this our higher high? Because we had a series of candles following each other and going down. So meaning this is our retracement and this is our impulsive. The impulsive is where the market went up, then the retracement is where the market tried to go down. And why do I say it tried to go down and here I never said it went down? Here there are a series of candles following each other and breaking each other lows. Okay, if you're to see here, this candle, this was the last candle that printed, okay, before the market tried to go down. Then this candle printed, it went below this candle. Okay, it swept the lows of this candle, but there was no any other candle that swept the lows of that candle, so meaning that would not qualify to be our higher low. But if we see this was the last candle and the market followed by and this candle was followed by this candle that swept the low of this candle, following by another candle that swept the next candle, like that. Okay, until it made the last tip before it went up, so making this our higher low and making this our higher high. Okay, so after printing this candle, after this candle breaking this, okay, after the market breaking this higher high, it also printed other candles going down, making this our higher low, because this is the last point before the market reversed and broke this higher high. I hope now you can understand what's higher low, higher high, a bullish market, impulsive move, and retracements. Okay, so that's it. This is the impulsive move. Okay, this is the retracements. These are the retracements, and these are the higher highs, and these are the higher lows. Okay, so that's what we call a bullish market. So the next thing is what's a ranging market? So what's a ranging market? So a ranging market is where the market is in between a higher low and a higher high. It's neither breaking the higher low and it's neither breaking a higher high. Okay, it's just in that range. Okay, let me show you from this real example. Let me first delete this quick. So if we are to see here, the market went up from here, then it came here. This is our higher high. It came here making our higher low. Then it came here and made our higher high. Okay, so after making this higher high, the market stayed in this range. So this is the range that I'm actually talking about. Okay, so the market stayed in this range without breaking neither the highs or the lows. It stayed in this range, okay, without till it broke here with a candle close. So I have introduced another word, a candle close. Okay, so we have what we call a sweep and we have what we call a candle close. So a candle close is when a candle closes above a level, and like a candle closes with a body. If you're a real beginner, you may be not knowing a body. Let me explain quick what's a body. Okay, so a body, we have what, like, our candle looks like this. Okay, so our candle looking like this, meaning this is what we call a wick, and this is what we call a body. Okay, this is what we call a body. So if this is the body and this is the wick, when I say when the candle closes with the body, I'm meaning if a candle closes just like this one here, okay, just like this one here, as you can see, so meaning this candle closed above this red line with a body. But if I say that the candle closed with a sweep, so meaning I'm trying to sell something just that looks like this. The candle, yes, it came below that level, but it never left a body behind below that level. So meaning this is not a break, that's a sweep. So that's what we call a sweep. If a candle comes onto a level and it just leaves there a wick, meaning that's a sweep. Okay, so I have now introduced other three words. I have introduced the word ranging, and I have introduced sweep, and I have introduced a candle close. So those are the three things. Okay, so if the market keeps in a level without breaking either the higher low, okay, or the higher high, so meaning the market is ranging. Other people always say the market is consolidating. Okay, so you can either say the market is consolidating or the market is ranging, or the two words, it's the same thing. Okay, yeah, so that's a ranging market. Okay, so after ranging market, we have something else. We have another thing we call a bearish market. So a bearish market is the opposite of a bullish market. Okay, so a bearish market is an opposite of a bullish market. We said a bullish market is a market that's going up. Okay, that's going up, making a series of higher high, higher low, higher high, higher low, higher high, higher low. And I have explained everything that you can understand what's now a higher low is and what's a higher high. Okay, so I have also explained to you what's a range, where I've talked about it's when the market is not breaking either a higher low or a higher high. So the bearish market is the opposite of this. Okay, let me show you an example of what's a bearish market. Okay, so let me first look for the example to show you here. Then after teaching you what's a bullish market, I'm going to combine both the bearish market, the bullish market, and the range, so that we can understand on how you can read the charts and know when the bearish market kicks in, or when the bullish market kicks in, or when the market is just in a range, so you can rule out on when to trade or when not to trade. Okay, so where can I get a bullish market? Okay, there is one here. So what's a bearish market? The bearish market is just the market is making a series of lower high and lower lows. Okay, so a lower high is a lower low is the lowest point. This lowest point the market makes before is the lowest point the market makes before trying to make a consolidation or trying to reverse. Okay, let me explain it like this. So a lower low is the last point the market makes before trying to reverse. Okay, so let me first delete these so that I can explain to you very well. Okay, so a lower low is the last point the market makes, and this is the last point the market made before going up. Okay, before going up, and which we called reversing. Okay, before reversing a little bit to make another lower high. Okay, so this is a lower high, and the lower high is the highest point before the market makes an impulsive move to break the lowest level. Okay, and this is the lowest level before the market, this is the lowest level the market made before reversing. So if the market breaks it, meaning we shall make a new lower low. So this is a lower low, and this is the point the market makes before reversing to make the highest point that the market makes to break this lower low. Okay, so this is a lower low, and this is a lower high. Okay, this is a lower low and this is a lower high. So that's it. Okay, so I've now introduced a lower low and a lower high. It's just a shifting words, but it's the same thing with the bullish market, just shift the words. Okay, so let me show you here on the real example. So the market made this low. Okay, it made this low, then it made a series of candles going up, making it a reversal. Okay, making it a reversal. Okay, or making it a Okay, we call it a reverse, making it a reverse. So this is the highest point the market made before breaking the lowest point the market made before reversing. Okay, and that's a lower high. Okay, then the market made this point and it went up. It made the lowest low, and then before breaking this lowest low, this was the highest low. Okay, this was the highest point. Then we went down, it made this lowest low, and before breaking it, after reversing, it made this highest point before breaking this, meaning this is our lowest, our lower high. So that's it. That's a lower low, lower high. Simple things. Hope you have understood that. Okay, so I don't want to make this video too long. I think that I've explained what's a lower low and lower high. I've explained what's a higher low and a higher high. Then I've explained a reversal and an impulsive move. I've explained what's a bearish and a bullish market. Okay, so I will make another video just soon to explain the break of structure, the change of character, just not to make this video too long for you not to understand.